Hello, dear students. Hope you are well. The weather is fine, and the mood is good. And let us continue with the rest of slides from the previous session and discuss some additional performance measures that are used in an area of project finance. And also we will discuss the common pitfalls and the process of capital allocation or investment decision. If you have any questions regarding the previous material or your home task, please raise a hand or type in the chat. We'll discuss all the issues. So let us start from the return on investment, or ROI. It is a ratio between net profit over some specific period and a cost of investment, resulting from an investment of some resources at a point in time. A high ROI means the investment's gains compare favorably to its cost. As a performance measure, return on investment is used to evaluate the efficiency of an investment or to compare the effectiveness of several different investments. In economic terms, it is one way of relating profits to capital investment. Return on investment can be calculated in different ways, depending on the goal and application. The most comprehensive formula is that return on investment in percentage equals the sum of current value of investment and income from investment minus initial investment and other expenses divided by initial investment and other expenses and multiplied by 100%. For a single period review, divide the return or net profit by the resources that were committed or invested. So in that case, return on investment is the net income divided by investment, where net income equals gross profit minus expenses and investment equals stock plus market outstanding when and plus claims, or it can be calculated as follows. Return on investment equals gains from investment minus cost of investment, both divided by the cost of investment. Or alternatively, the third formula, the return on investment equals revenue minus cost of goods sold, both divided by the cost of goods sold. The purpose of the return on investment metric is to measure per period rates of return on money investment in an economic entity in order to decide whether or not to undertake an investment. It is also used as an indicator to compare different investments within a portfolio. The investment with the largest ROI is usually prioritized, even though the spread of return on investment over the time period of an investment should also be taken into account. Return on investment and related metrics provide a snapshot of profitability adjusted for the size of the investment asset tied up in the enterprise. ROI is often compared to expected or required rates of return on money investment. ROI is not time adjusted. So most textbooks or most academicians describe it with their year zero investment and 2 to 3 years income. So be aware of the definitions. There is several limitations with the usage of return on investment. As a decision tool, it is simple to understand. The simplicity of the formula allows users to freely choose variables. For example, the length, all the calculation time, whether overhead cost is included, or which factors are used to calculate income or cost components. Use of ROI as an indicator for prioritizing investment projects alone can be misleading, since usually the ROI figure is not accompanied by an explanation of its makeup. ROI should be accompanied by the underlying data that forms the inputs. This is often in the format of the business case. So long-term investment, the need for a net present value adjustment is great, and without it, the ROI is incorrect. Similar to discounted cash flow, a discounted ROI should be used instead. One limitation associated with the traditional ROI calculation is that it does not fully capture the short-term or long-term importance, value, or risk associated with the capital. There is also another performance indicator or measure, that is return on equity, or ROE, the measure of the profitability of a business in relation to the equity. Because shareholders' equity can be calculated by taking all assets and subtracting all liabilities, ROE can also be thought as a return on assets minus liabilities. Return on equity measures how many dollars of profit are generated for each dollar of shareholders' equity. ROE is a metric of how well the company utilizes its equity to generate profits. ROE is especially used for comparing the performance of companies in the same industry. As with the return on capital, ROE is a measure of management's ability to generate income from the equity available to it. ROEs of 15 to 20% are generally considered good. ROE is also a factor in stock valuation in association with other financial ratios. While higher return on investment ought intuitively to imply higher stock prices, higher valuation of the project, in reality, predicting the stock value of a company based on its ROE is dependent on too many other factors to be used only by itself. We can also discuss the DuPont formula, also known as a strategic profit model, and is a common way to decompose ROE into three important components. Essentially, ROE will equal the net profit margin multiplied by asset turnover multiplied by financial leverage. Splitting return on equity into three parts makes it easier to understand changes in ROE over time. For example, if the net margin increases, every sale brings in more money, resulting in a higher overall ROE. Similarly, if the asset turnover increases, the firm generates more sales for every unit of assets owned, again, resulting in a higher overall ROE. And finally, increasing financial leverage means that the firm uses more debt financing relative to equity financing. Interest payments to creditors are tax deductible, but dividend payments to shareholders are not. Thus, a higher proportion of debt in a firm's capital structure leads to a higher ROE. Financial leverage benefits diminish as the risk of defaulting on interest payments increases. If the firm takes on too much debt, the cost of debt rises as creditors demand the high risk premium and ROE decreases. Increased debt will make a positive contribution to a firm's ROE only if the matching return on assets of the debt exceeds the interest rate on the debt. And the third performance indicator, very often used in real estate and project financing, it is the cash on cash. Cash on cash returns is a ratio of annual before tax cash flow to the total amount of cash invested, expressed in a percentage. It is often used to evaluate the cash flow from income-producing assets. Generally consider it a quick napkin to test the to determine if the assets qualifies for further review and analysis. Cash-on-cash analysis are generally used by investors looking for properties where cash flow is paramount. However, some use it to determine if a property is undervalued, indicating instant equity in a property. There is also limitations for the usage of cash-on-cash return ratio. Because the calculation is based solely on deferred tax cash flow relative to the amount of cash investment, it cannot take into account an individual investor's tax situation, the particulars of which may influence the desirability of the investment. However, the investor can usually deduct enough capital cost allowance to defer the taxes for a long time, and that is often in the case of project finance. Please keep it in mind. The formula does not take into account any appreciation or depreciation. When some cash is a return of capital, it will falsely indicate a higher return because return on capital is not income. It does not account for other risks associated with underlying property. It is essentially a simple interest calculation and ignores the effect of compounding interest. The implication for investor is that an investment with a lower nominal rate of compound interest may be superior, and in the long term, to investment with a high cash-on-cash return. And it's possible to perform an after-tax cash-on-cash calculation, but accurate depictions of your adjusted taxable income are needed to correctly address how much tax payment is being saved through depreciation and other losses. And there, at the bottom of this session, let us discuss the common capital allocation pitfalls that is applied to every process of allocating your capital either among different projects or for a very specific project. So although the principles of a capital allocation and investment decision may be easy to understand, applying the principles to real-world investment opportunities can be challenging for companies. Some of the common capital allocation mistakes that companies make are listed on this slide. So the companies can not incorporating economic responses into the investment analysis. That means economic responses to an investment often affect its profitability. And these responses have to be correctly anticipated by companies. For example, in response to a successful investment, competitors can enter and reduce the investment's profitability. Companies that make highly profitable investments often find that a competitive marketplace eventually causes profitability to revert to normal levels. So that means no free lunch at all. If you discover some potentially profitable business and employ it, but it can easily replicate it, then you should expect the band of competitors will arrive instantly and your margins will diminish. The next, misusing capital allocation templates. Because hundreds or even thousands of investments need to be analyzed over time, individuals assessing these opportunities on behalf of the company sometimes use standardized capital allocation templates in evaluating investment. The situation creates risks of the template model does not match the investment of, or if inappropriate information is used. And I should say, yes, there is even some startups or internet projects that offers your instantly developed Excel spreadsheets that, as they say, can be easily applied to every situation and every business, and it's cheap. You shouldn't develop some Excel formulas. You shouldn't think about the correctness, the errors, etc., etc., etc. But it is not the case. from my experience, I should say, you cannot. So there is virtually no case when you can instantly take some template from the internet or from your archive and apply to new project. You always should carefully consider whether assumptions like microeconomic assumptions are relevant to this situation. How you calculate tax impact, how you calculate the revenue side, how you calculate what composes your costs, what are the financing costs. So please be aware of this and try, even if you use some already predefined, pre-developed template for a project, please consider whether the uh, structure of the inputs, the calculation are correct, the outputs are relevant to the purpose of your investment analysis. There is also other pitfalls like pushing the pet projects. Often pet projects are selected at companies without undergoing normal capital allocation analysis. Or the pet project receives the analysis, but overly optimistic projections are used to inflate the investment's profitability. And this is often the case even in very developed companies where your supervisor, your boss, top manager pushes the project he or she wants to be invested in. You should always be on the side and represent rational due diligence in this approach. Try to take a very so unaffected by the pressure from your supervisor position, and to argue on the very deterministic principles of how the investment should be assessed. There is also other pitfalls like basing investment decisions on earnings per share, net income, or return on equity. The companies sometimes have incentives to boost earnings per share, net income, or return on equity, and many investments, even those with strong NPVs, do not increase these accounting numbers in the short run and may even reduce them. Paying too much attention to short-run accounting numbers can result in a company choosing investments that are not in the long-run economic interest of its shareholders. Also, using IRR to make investment decisions can be one of pitfalls. The NPV criterion is economically sound. The IRR criterion is also sound for companies undertaking independent investments with conventional cash flow patterns. For investment opportunities that are mutually exclusive or competitive with each other, using IRR criterion and not NPV can result in suboptimal investment decisions. Furthermore, the IRR methodology should never be used with non-conventional cash flows projects because it results in more than one solution. And you can effectively judge which solutions are good or not. Correctly accounting for cash flows in analyzing a complicated investment, individuals assessing the investment for the company may erroneously omit relevant cash flows, double count cash flows, and mishandle taxes. So it's more about the accuracy in calculating cash flows and accounting for the model. The next slide contains other pitfalls. So over or underestimating overhead costs. That is the case in many instances in many projects. In large companies, the cost of investment may include the overhead it generates for such things as management time, information technology support, financial systems, and other support. Although these items are hard to estimate, over or underestimating these overhead costs can lead to incorrect analysis by the companies. And it's often the case of small companies when you have the salaries for your management, and this management is responsible for many projects, but his her time and salary are not accounted as the cost of the project. That leads to the situation when the budget are ruined, and even the cases when you have not enough cash to pay the salaries for your employee. So please try to account for the costs of the personnel that acts as a overhead division for your project, and considering the financing needed, you should account for this cost. Next pitfall, not using the appropriate risk-adjusted discount rate. The required rate of return for an investment should be based on its risk. If the company is financing an investment with debt, the investment's required rate of return, not the company costs of debt, should still be used. Similarly, a high-risk investment being considered should be discounted not at the company's overall cost of capital, but at the investment's required rate of return. Discount rate errors have a huge impact on the computed NPVs of long-lived investments. Overspending and underspending the capital allocation. Spending all of the investment allocation just because it is available and is another common mistake made by companies. A well-run company managers will return excess funds whenever the profitable investments cost less than the allocation, and managers will make a sound case for extra funds if the allocation is too small. And this is often the case in our companies in Russia and in the global market. There is a rule so-called use it or lose it. Means if you have the investment or capital allocation budget left, you should use it, because there is high probability that you will receive decreased budget for these purposes next year if you do not use all the budget that are given to you this year. And that is the reason why we have a lot of investment projects and opportunities comes from the companies at the end of financial year. So they try to employ as much capital as possible, but of course it's not sometimes, but usually it's not economically sound and effective. The next pitfall is to failing to consider investment alternatives or alternative stages or alternative states. Generating good investment ideas is the most basic step in the capital allocation process, and many good alternatives are never even considered at some companies. In addition, many companies fail to consider different states of the world, which can be and should be incorporated through break-even scenario and simulation analysis or whatever. And the last pitfall, incorrectly handling sunk costs and opportunity costs. Ignoring sunk costs is difficult for companies to do. Further, not identifying the economic alternatives, real and financial, that are the opportunity cost is probably the biggest failure for companies in their analysis. Only costs that change with the decision are relevant. So that's the rest of the lecture 4 that we didn't pass last session. If you have any question regarding the principles of capital allocation, the performance measures, please raise a hand or type in the chat. We'll discuss. And at that point, we can move to the next session devoted to the valuation and financial modeling. So let us have a short break for 5 minutes. You can have a rest, make a cup of coffee or tea. And if you have any questions regarding the homework, please also raise a hand or type in the chat. I will answer it. 5 minutes. We'll meet at 1:30. Okay, let's move on and talk about the valuation and financial modeling. The purpose of this session is to provide a conceptual understanding of free cash flows and the valuation models based on them. A detailed accounting treatment of free cash flows and the more complicated valuation models will follow this session. Free cash flow to the firm is the cash flow available to the company's suppliers of capital after all operating expenses, including taxes, have been paid and necessary investments in working capital, for example, in inventory, and fixed capital, for example, in equipment, have been made. And free cash flow to the firm, or FCFF, is the cash flow from operations minus capital expenditures. A company's suppliers of capital include common stockholders, bondholders, and sometimes preferred stockholders. The equations analysts use to calculate FCFF depend on the accounting information available. Then free cash flow to equity is the cash flow available to the company's holders of common equity after all operating expenses, interest, and principal payments have been paid and necessary investments in working and fixed capital have been made. FCFE is the cash flow from operations minus capital expenditures minus payments to plus receipts from debt holders. The way in which free cash flow is related to the company's net income, cash flow from operations, and measures such as EBITDA, earnings before interest, taxes, depreciation, and amortization is important. The analyst must understand the relationship between a company's reported accounting data and free cash flow in order to forecast free cash flow and its expected growth. Although a company reports cash flow from operations, CFO, on the statement of cash flows, CFO is not free cash flow. Net income and CFO data can be used, however, in determining a company free cash flow. The advantage of FCFF and FCFE over other cash flow concepts is that they can be used directly in this DCF framework to value the projects or value equity. Other cash flow or earnings related measures such as CFO, net income, EBIT, and EBITDA do not have this property because they either double count or emit cash flows in some way. For example, EBIT and EBITDA are before tax measures, and the cash flows available to investors must be after tax. From the stockholders' perspective, EBITDA and similar measures do not account for differing capital structures or for the funds that bondholders supply to finance investments in operating assets. Moreover, these measures do not account for the reinvestment of cash flows that the company makes in a capital assets and working capital to maintain or maximize the long-run value of the firm. Using free cash flow in valuation is more challenging than using, for example, dividends, because in forecasting free cash flow, the analyst must integrate the cash flows from the company's operations with those from its investing and financing activities. Because free cash flow to the firm is after-tax cash flow going to all suppliers of capital to the firm, the value of the project is estimated by discounting FCFF at the weighted average cost of capital, WACC or WACC. An estimate of the value of equity is then found by subtracting the value of debt from the estimated value of the project. The value of equity can also be estimated directly by discounting free cash flow to the equity at the required rate of return for equity, because FCFE, the cash flow foregoing to common stockholders, the required rate of return on equity is the appropriate risk-adjusted rate for discounted FCFE. The two free cash flow approaches for valuing equity, free cash flow to the firm and free cash flow to the equity, theoretically should yield the same estimates if all inputs reflect identical assumptions. An analyst may prefer to use one approach rather than the other. However, because of the characteristics of the company being valued and the project being valued. For example, if the company's capital structure is relatively stable, using free cash flow to the equity to value equity is more direct and simpler than using FCFF. The FCFF model is often chosen, however, to other cases. A levered company with negative free cash flow to the equity. In this case, working with free cash flow to the firm to value the company's equity might be easiest. The analyst would discount FCFF to find the present value of operating assets, adding the value of excess cash, excess in relation to operating needs, and marketable securities, and of any other significant non-operating assets to get the total firm or project value. He or she would then subtract the market value of debt to obtain an estimate of the intrinsic value of equity. A leveraged, the second case is a leveraged company with changing capital structure. First, if historical data are used to forecast free cash flow growth rates, FCFF growth might reflect fundamentals more clearly than does FCFE growth, which reflects fluctuating amounts of net borrowing. And second, in a forward-looking context, the required return on equity might be expected to be more sensitive to changes in the financial leverage than changes in a weighted average cost of capital, making the use of a constant discount rate difficult to justify. And it's often the case of project finance. Specialized DCF approaches are also able to facilitate the equity valuation when the capital structure is expected to change. The adjusted present value, or APV, approach is one example of such models. In APV approach, firm value is calculated as the sum of the value of the company under the assumption that debt is not used, that is unlevered firm value or unlevered project value, and the net present value of any effect the debt on the firm value, such as any tax benefits of using debt and any costs of financial distress. In this approach, the analyst estimates unlevered company value by discounting FCFF, so under assumption that there's no debt, and the unlevered cost of equity, the cost of equity given that the firm does not use debt. Let's talk about the valuation aspects. We have two distinct approaches to using free cash flow for valuation, and that is FCFF valuation and FCFE valuation. The general expressions for these valuation models are the value of company or project equals the present value of forecasted dividends or other surplus payment from time 1 through infinity, discounted at the required rate of return for this project. So the present value of FCFF, the FCFF valuation approach estimates the value of the firm at the present value of future FCFF discounted at the weighted average cost of capital. Because FCFF is the cash flow available to all suppliers of capital, Using weighted average cost of capital to discount FCFF gives the total value of all the firm's capital. The value of equity is the value of the firm minus the market value of the debt. So we have the final equation, the equity value on the firm value minus value of debt. Dividing the total value of equity by the number of outstanding shares, if we evaluate the company, gives the value per share. But in our case, we comes to the value of the project. If you have some shares issued by your project company, probably it will be approached to calculate the value of the shares or stakes if it is a partnerships. The cost of capital is the required rate of return that investors should demand for a cash flow stream like that generated by the company being analyzed. Weighted average cost of capital depends on the riskiness of these cash flows. Weighted average cost of capital is the weighted average of the after corporate tax required rates of return for debt and equity, where the weights are the proportion of the firm's total market value from each source, debt and equity, or just in the case of project finance, the proportion of finance provided via equity or via debt. As an alternative, analysts may use the weights of debt and the equity in the firm's target capital structure when those weights are known, so in case of project finance, and differ from market value weights, or even we have no market weights, as in the case of project finance. And here is the formula for the weighted average costs of the capital. Okay. The present value of free cash flow to the equity calculated very similar to the present value of free cash flow to the firm. So we will not make a stop on it. Just consider that the not weighted average cost of the capital should be used, but required rate of return on equity. How to compute FCFF from named income? Estimating FCFF or FCFE requires a complete understanding of the project and its financial statements. To provide a context for the estimation of FCFF and FCFE, we first discuss the calculation of free cash flows, including the relationship between free cash flow and accounting measures of income. We then describe approaches to forecasting free cash flow. Free cash flow to the firm is the cash flow available to the company as suppliers of capital after all operating expenses have been paid and operating investments have been made. Keeping in mind that the non-cash charges is a charge of or expense that does not involve the outlay of cash, we can write the expression for FCFF as follows. You can see here that it is a formula, and let us consider each component of the free cash flow to the firm. The starting point is in this equation is the net income available to common shareholders, usually, but not always, the bottom line or in an income statement of your financial statements. It represents income after depreciation, amortization, interest expense, income taxes, and the payment of dividends to preferred shareholders. To derive cash flow from net income, it is necessary to make adjustments for any items that involved decreases and increases in the net income, but did not involve cash inflows or outflows. So you have to make adjustment for non-cash changes in net income. These items are referred to as non-cash charges. If non-cash decreases in net income exceeds the increases, it is usually the case the total adjustment is positive. If non-cash increases exceed non-cash decreases, the total adjustment as negative. So you have to reverse the sign of the net adjustment. The most common non-cash charge is depreciation expense. The depreciation expense reduces net income, but is not the cash outflow. Depreciation expense is thus one and the most common non-cash charge that must be added back in computing free cash flow to the firm. In the case of intangible assets, there is a similar non-cash charge called amortization expense, which must be added back. Other non-cash charges vary from company to company, and we will discuss it later. Next component, after-tax interest expense must be added back to net income to arrive at free cash flow to the firm. This step is required because interest expense net of the related tax savings was deducted in arriving at net income. But interest is the cash flow available to one of the company's capital providers, that is, the company's creditors. In many countries, interest is tax deductible, reduces taxes for the company and borrower, and taxable for the recipient, lender. When we discount free cash flow to the firm, we use an after-tax cash cost of capital. And for consistency, we thus compute free cash flow to the firm by using the after-tax interest paid. We could compute weighted average cost of capital on a pre-tax basis and compute free cash flow to the firm by adding back interest paid with no tax adjustment. Whichever approach is adopted, the analyst must use mutually consistent definitions of free cash flow to the firm and weighted average cost of capital. Similar to the treatment of after-tax interest expense, dividends on preferred stock that are deducted in arriving at net income available to common shareholders must be added back to derive free cash flow to the firm. The reason for the add back is that preferred stock dividends are also cash flow available to one of the company's capital providers and thus constitute part of overall free cash flow to the firm. The next component is the investments and a fixed capital, which represents the outflows of cash to purchase the fixed capital necessary to support the company's current and future operations. These investments are capital expenditures for long-term assets such as property, plant, and equipment, commonly referred to as PP&E or simply PPE, necessary to support the company's operations. Necessary capital expenditures may also include intangible assets such as trademarks or patents. In the case of cash acquisition of another company instead of direct acquisition of PPE, the cash purchase amount can also be treated as a capital expenditure that reduces the company's free cash flow. Finally, the adjustment for net increases in working capital represents the net investment in current assets such as account receivable less current liabilities such as accounts payable. Although working capital is often defined as current assets minus current liabilities, working capital for cash flow and valuation purposes is defined to exclude cash and short-term debt, which includes notes payable and the current portion of long-term debt. When finding the net increase in working capital for the purpose of calculating free cash flow, we define working capital to exclude cash and cash equivalents, as well as notes payable and the current portion of long-term debt. Cash and cash equivalents are excluded because a change in a cash is what we are trying to explain. Notes payable and current portion of long-term debt are excluded because they are liabilities with explicit interest costs that make them financing items rather than operating items. And let us switch to the Excel example I would like to show you. We have several calculations made on the basis of very real situations. So I can send this Excel right to you in the chart or via email, whatever is preferable for you. Please let me know. But that is the spreadsheets developed by myself, and you can also see here not only the approach for calculating any methods of getting to free cash flow to the firm or free cash flow to the equity, but also the style of which the best practice for applying to developing a financial model. So you have to separate spreadsheet or a table with assumptions, then you have some calculations, and you have to it's better to somehow to indicate what is the input cells or input components of your calculation and what is the results, and you can also easily check how it is derived. I'm not marketing any solution, but I can present you a very good tool called Excel that helped me well of getting any information about how these things are calculated in Excel. For example, we can try to understand how the cell calculated, not to go to the formula here, but arrive at some specific result, like here, here, and here, and try just to switch to the navigation window, where we can see that, for example, we have cell E64, that is a interest expense multiplied by 1 in tax rate, and it has two components, the interest expense and the formula for calculating the second product component of a product. So let's go back to the case. So Kane Distribution Incorporated on 31st December 2017 with initial capital infusion of 224,000 of debt and 336 of common stock, acts as a distributor of industrial goods. The company managers immediately invested the initial capital or in fixed capital, so they purchased some equipment, for example, at cost of 500,000 and working capital of 60,000. Working capital initially consisted solely of inventory, so they purchased something to distribute. The fixed capital consisted of non-depreciable property of 50,100 and depreciable property of 450,000. The depreciable property has a 10-year useful life, is no salvage value. So we here have an exhibit that provides the Kane's financial statement for the 3 following years. Please, the task, calculate the FCFF starting with net income. So let's go. We have our net income here, and we have these proportions that is non-cash charges like depreciation. Then we add back interest expense, then investment in a fixed capital and investment in working capital. And you can see again the formula that sum up all these components, very straightforward, like in the slides we have. So we have a question from Igor Hustochkin. Why do we not take into account financial investment in free cash flow? You mean free cash flow to the firm or free cash flow to the equity? And please give some ideas about this both. But you mean financial investment is the financing provided, so the financial stream.
I mean financial investments,
Sorry.
like in РСБУ,
Mm,
финансовые вложения.
I should apologize. I had some external sounds here. Please repeat what you mean.
I mean financial investments like in РСБУ, it's named финансовые вложения. So it's also some kind of liquid assets as cash.
Yes, but we can have it later when we because it's not the nature of your business. It's like your can be treated as your net cash or net debt. So you can add it after you're calculating the streams, financial cash flow streams that comes from your business. So in this sense, we can, when arriving at the stock, the cost of the equity, you should first evaluate your company or project using this DCFF approach, and then subtract or add net borrowing and this cash, net cash, and the financial investment also be treated as a cash because they can be instantly converted to the cash. So it's a highly liquid investments, and add this component to valuation. While adding the value for your equity, it's not adding the value of your project, because your project is to originate, expand, manage cash flows coming from your business. If you are a financial company or corporation, you can treat your investments in financial assets as your core business, but it's really a very specific case. Is the case? You have any other?
Yes, thank you.
So just consider it as a component you should add after valuing the project, and you can treat it as a net cash. Good. Okay, let's come back. If you have any questions regarding Excel, please raise a hand or type in the chat. I can send these Excel spreadsheets for you right here in the chat, so you can open it on your PC and try to navigate, try to change or understand the formulas on your own. So do you like for me to send it to you right now? Just a minute. Here you are. Oh. I should close it first. Okay. So here you are. Okay, we'll come back later to the same file. Now to the lecture. Then the next issue, FCFF. So it is a cash flow that is available to all providers of the capital, and analysts frequently use cash flow from operations, or CFO, taken from the statement of cash flows as a starting point to compute free cash flows, because CFO incorporates adjustments for non-cash expenses such as depreciation and amortization, as well as for net investments in working capital. In most cases, companies include interest paid or as a part of operating cash flow. Under US General Accepted Accounting Principles, or GAAP, companies must include interest paid in operating cash flow. And the International Financial Reporting Standards, IFRS, the companies may include interest paid in either financing or operating. Most IFRS reporting European firms choose to classify interest paid within the operating cash flow section of the statement of cash flows. This will be discussed later, boss, and assuming that interest paid is included in operation cash flow, free cash flow to the firm can be estimated as follows. You can see the formula here. And to reiterate, as with the calculation on the previous slide, the after-tax interest expense is added back because it was previously taken out of net income, but must be included in free cash flow to the firm because it is a component of the total cash flows available to all suppliers of the firm's capital. In comparison to the previous equation, neither depreciation nor the investment in working capital appears in the new equation because both are already included in the CFO. And let us look at the next example. You can open your spreadsheet as well. It is a SS 5.2. And this example illustrates the use of CFO to calculate free cash flow to the firm. The operating section of the statement of cash flows begins with net income and presents each adjustment required to derive operating cash flow. This presentation known as indirect method because it derives operating cash flow indirectly from net income via adjustments is the most common presentation of the statement of cash flow that we have. So you can see here, you can open the solution, you can see how we arrive at free cash flow to the firm. So it's again, we start with cash flow from operations, add back interest expense multiplied by 1 minus tax rate, and adding the investment in a fixed capital. Please feel free to use any templates here, any formulas, etc. It's all yours. Come back to the lecture. Here, the list of adjustments to derive operating cash flow from net income. And whether an analyst selects net income or cash flow from operations as a starting point in calculating free cash flows, some situations warrant a closer examination. We will review the common adjustments for non-cash charges made in deriving cash flow from net income and highlight several areas that merit additional attention from us. The operating cash flow section of the statement of cash flows provides detail on the adjustments made in deriving operational cash flow from net income. This table summarizes the common adjustments to derive operating cash flow from net income and indicates whether each item is added or subtracted from net income in arriving at free cash flow to the firm. An adjustment to reported net income is required for any item that was treated as an expense in calculating net income on the net income statement, but did not result in equivalent cash outflow in the reporting period. For example, both depreciation and amortization expenses reduce net income, but neither involves a cash outflow in the period. Therefore, to derive operating cash flow or free cash flow to the firm from net income, it is necessary to add back this amount to net income. Adjustments to eliminate the amount of gains and losses are made for two reasons in general. First, such transactions are typically not operating expenses. For example, a sale of fixed assets, which is an investing activity. And thus, the effects must be removed from the operating section of the statement of cash flows. Second, the amount of gain or loss reported in the net income statement is not necessarily equivalent to the amount of cash involved in the transaction. For example, if a company sells a piece of equipment with a book value of 60,000 euros for 100,000 euros, it reports the 40,000 euros gain as a part of net income. The 40,000 gain, however, is not equivalent to the transaction cash flow and therefore must be subtracted to derive operating cash flow from the net income. Further, the 100,000 is a cash flow, and that amount will appear as a component of the company's cash flow for investing activity. Alternatively, if the company had sold the equipment with a book value of 60,000 euros for 40,000 euros and thus reported a loss of 20,000 as a part of net income, that amount would be added back in deriving operating cash flow and free cash flow to the firm. So please keep in mind these adjustments and how they affect the free cash flow to the firm and free cash flow to the equity. And at the end of this session, we'll have a very interesting quiz. So be prepared. No worries about whether you will give correct answers or not. It's just, again, very interesting, very interactive knowledge check for you. Okay. There is also a very interesting point to stress. We can compute free cash flow to the equity from free cash flow to the firm. Just to reiterate, that free cash flow to the equity is a cash flow available to the common shareholders. The cash flow remaining after all operating expenses have been paid, capital investments have been made, and all the transactions with other suppliers of capital have been carried out. The company's other capital suppliers include creditors such as bondholders and preferred stockholders. The cash flows net of taxes that arise from transactions with creditors and preferred stockholders are deducted from free cash flow to the firm to arrive at free cash flow to the equity. And free cash flow to the equity is the amount that the company can afford to pay out as a dividends or distribute between the shareholders. Actually, for various reasons, companies often pay out substantially more or substantially less than free cash flow to the equity. So free cash flow to the equity often differs from dividend pay. The reason for this difference is that the dividend decision is a discretionary decision of the board of directors. Most corporations manage these dividends. They prefer to raise them gradually over time, partly because they do not want to cut dividends. Many companies raise dividends slowly, even when their earnings are increasing rapidly, and companies often maintain their current dividends even when their profitability has declined. Consequently, earnings are much more volatile than the dividends. That means you have to present a good story on the market and supply to the project finance too. So it's better to keep the steady pace of increasing or maintaining your dividends instead of have very volatile dividends payout policy. And we have next example. It says 5.3 that illustrates how to adjust net income or CFO to find FCFF and FCFE. So let us consider this example. We have a balance sheet, net income statement, statement of cash flow for the Pitts Corporation, and they are shown below. The statement of cash flow follows a convention according to which the positive number of 400 million and 85 million for cash used for investing activities and cash used for financing activities respectively indicate outflows, and this amount to be subtracted. For you is just to consider what sign in the formula you should apply, minus or plus. And this will also encounter a convention in which the value 400 for cash provided by investing activities would be used to indicate the subtraction or 400. So it's usually the case for companies operating in the United States, so they like to do so. And you can see that we have here the calculation for free cash flow starting with the net income. Again, opening a formula, and we can easily navigate through the components. We're starting with net income. So everyone can see clearly and correctly to which cells and corresponding line items the navigation using this Explorer shows you. So no problem with it. Okay, I see no problem. Then we add back depreciation. We have our interest expense added back multiplied by 1 minus interest rate. Here you are. You can see that is minus 400. So we, if we will have in a statement and negative figures, then we will add it. But according to the convention used, these figures represented with the plus sign, so we should subtract it. But it's only an accounting approach, representation approach even. And changes in the working capital also added back. You can see it. So here how we arrive at free cash flow to the firm. Then how to get free cash flow to the equity, starting from the free cash flow to the firm. We have the free cash flow to the firm calculated first, then subtracting the this effect of the interest expense, subtracting changes in a notes payable and long-term financing insurance. So removing financial activities, that means that this is amount of cash flow available to the common stockholders or the equity capital providers after deducting all distributions made to other capital providers like bondholders, lenders, etc., etc. Again, calculate free cash flow to the equity starting from the directly from the net income. You can see different approach. We have net income, then add back depreciation, subtract the 400 of cash used for investing activities. Again, remember that it's just we're subtracting because it's have a positive sign here, while in other conventions it will have negative sign. Again, changes in working capital, all the components, and right here we subtract the financial distributions, and we arrive at pretty the same figure, 117. Let us check if it works for FCFF too. Let us calculate FCFF directly starting from CFO. Again, our navigator, we start with cash provided by operating activities. We add interest expense multiplied by 1 minus tax rate, and again we subtract but add a negative figure in other conventions, so the investment cash flow. And it is the same figure as we have when we started calculating FCFF from net income. So the pretty same approach for the calculating FCFE starting from CFO. Please use it cases, use it formulas. It's all for you. And the next topic is finding free cash flow to the firm and free cash flow to the equity from EBITDA and EBIT. It's a very common situation for many financials models. So FCFF equals EBITDA times 1 minus tax rate plus depreciation times the tax rate minus investment in fixed capital and working capital. Just compare these equations and look how the difference in depreciation is handled. Many adjustments for non-cash charges that are required to calculate free cash flow to the firm when starting from net income are not required when starting from EBIT or EBITDA. In the calculation of net income, many non-cash charges are made after computing EBIT or EBITDA. So they do not need to be added back when calculating free cash flow to the firm based on EBIT or EBITDA. Another important consideration is that some non-cash charges, such as depreciation, are tax deductible. A non-cash charge that affects taxes must be accounted for. In a summary, in calculating free cash flow to the firm from EBIT or EBITDA, whether an adjustment for non-cash charges is needed depends on whether in the income statement the charge has been deducted. Furthermore, the form of any needed adjustment depends on whether the non-cash charge is a tax deductible expense or not. We can also calculate free cash flow to the equity instead of free cash flow to the firm from EBIT and EBITDA. An easy way to obtain free cash flow to the equity based on EBIT or EBITDA is to use this equation you can see here, or the second equation that is also here. You can see it. You can just have a calculation starting from free cash flow to the firm and have free cash flow to the equity equals free cash flow to the firm minus interest expense multiplied 1 minus tax rate and adding net borrowing. But let us again move to the practical side of all these formulas and go to the example. We have again Pitt Corporation. We have the same financial statement, but we all now have the EBIT of 500 million and EBITDA of 800 million in year 2020. And let us show how we calculate free cash flow to the firm, free cash flow to the equity, starting from these two proxies of, it's also sometimes called the proxies of free cash flow. That's common definition for EBIT, EBITDA. You can go to solution and check again. So free cash flow from EBIT, we have an EBIT multiplied by 1 minus tax rate, adding back depreciation, adding back changes in working capital, and again these investments with a negative sign. Next, we'll calculate FCFE from EBIT. Very same approach. You start with EBIT minus interest expense, then all multiplied by 1 minus tax expense, depreciation, working capital changes, investments, and distributions. And pretty same approach, starting with the EBITDA. So EBITDA multiplied 1 minus tax rate, then adding back the depreciation that accounted for the proportion of tax rate, then also changes in working capital and the investment, and nearly the same, but with adjustments to the distributions to other capital providers. It is calculation of FCFE starting from EBITDA. Okay. Let us have a brief discussion of simple growth models, and then we'll have a break, and then we'll have a quiz. So one common two-stage model assumes a constant growth rate in each stage, And a second common model assumes declining growth in stage 1, followed by a long-run sustainable growth rate in stage 2. There are two common models that are often used in valuation. To forecast FCFF and FCFE, analysts build a variety of models of varying complexity. A common approach is to forecast sales with profitability, investments, and financing derived from changes in sales. Three-stage models are often considered to be good approximations for cash flow streams that in reality fluctuate from year to year. Non-operating assets such as excess cash and marketable securities, non-current investment securities, and non-performing assets are usually segregated from the company's operating assets. They are valued separately and then added to the value of the company operating assets to find a total firm value. So, Igor, you can see here another approach how to account for your financial investments in the marketable securities to arrive at valuation of your project or the company. It's also another possible approach. So, what about we have a break for 10 minutes and we will meet again at 2:30, okay? So fine. Hello, we are back to the quiz. Please enter this room and I will start the quiz. Not needed. Let's go. Okay, we have the following situation. You should indicate the effect on the FCFF and FCFE of a change in each of the items that will be listed below. Assume there is a $100 increase in each case, and we have the tax rate of 30% is applicable. So that means what is the effect on FCFF and FCFE if we increase a net income by $100? In any format, please write your answers. The point of this quiz and knowledge check for you to try answer and then to look at the correct answers and discuss why it is so. So just a very good, very efficient tool of refreshing your knowledge and checking your sense of the effect of various components of the cash flow and financial statements on the final figures of FCFF and FCFE. Please answer, no problem. We have 37 students. So I will move to the next question if the 30 of you will provide an answer. Okay, let's move. Mhm. some reason it's not showing. Sorry. Yes, the correct answer both will increase by 100, but let me check while it's not showing the answer. I will finish and relaunch the quiz, no problem. Probably I omit the instant answer here. Can you put something here just to check? It's not efficient here. Okay, I will use simultaneously two sources to give your correct answer. So we have both to look at the Excel spreadsheet and the Socrative. Oh, yes, because net income has a direct impact on calculating free cash flow to the firm with free cash flow to the equity. So increase net income by 100 leads to increase of all these financial cash flows projections by 100. Okay, no problem. Let's move to the next question. So I will do switching between the answers and your answers. No problem. Yeah. Now we have increase by 100 in cash operating expenses. You can simply put two figures like plus 100 for the FCFF and the next, for example, plus 100 for the FCFE. So
Sorry, Prof. I've not the new questions.
yeah.
I've only the first.
Sorry.
If not questions, I did the first question, and now in the screen there is right. You have completed the current activity, waiting for the next activity to begin.
Can you re-enter to the next to the room again and join us on the second question?
Okay, of course, perfect.
So no problem if you're already registered for the first try. I will not count it. Yeah, okay. Okay, interesting. -6, yeah, because it's the tax should apply. You can see your answers. So increase expenses, but the tax should be applied. Yeah. Okay. Move on. Now we increase depreciation by 100. Good. Let us see. Interesting. Interesting. Okay. Go with the answer. Yeah, plus 40. Yeah. So most of you are correct. Good. Good. On. Now we increase the interest expense by 100. Okay, let us check. So we have most answers getting 0 and minus 16. Yeah, so you're correct. Good. You're doing well. Going on. Now we increase a bit. Okay. Those plus 60. Here it's easy. Just remember the formula. You have to multiply the change in EBIT by 1 minus tax rate. Just keep it in mind. Okay. Yeah, this one, accounts receivable. Okay. Interesting. Ta-da. Yeah, you're correct. You're not getting the real cash. You just increase your accounts receivable. That means that the real cash will be less for this 100. Go on. Okay. Look. Yes. This very the same situation. Okay. Notes payable. Okay. Interesting. Yeah, you see, it does not affect the stream that goes to the company or firm, but it affects the stream only that goes to the shareholders, to the equity. Yeah, please consider, and the answer 0 plus 100 is correct. Another question, cash dividends paid. Okay. Yeah, most of you correct. No impact. It's below the stream that goes to the equity or the company. Next. The proceeds from issuing new common shares. Okay. Yeah, no impact again. Pretty same situation. No impact because it's below any streams that we are calculating. And the last one. Good. Yes, right. The same situation. That was new questions to confuse you, but you're okay. So that's all for our quiz. Was it interesting or difficult or too easy? Do you like this quiz or not? Okay, so shall we have a rest for 5 minutes before next session, or we can proceed right now? You want a 5 minute break? No more quizzes today. So let us have a 5 minute break and meet in 2:55. Good. Oh, we're back and we have questions regarding this quiz. So there is a characteristic of this system, so creative, it cannot count positive answer if you're not 100% use exact wording as in an answer. So we just can look through your answers and see that is correct, and they will count it as correct by me manually. So please don't worry, everything will be fine. Okay, good. Let's move on. So let's consider the process of financial modeling and the project evaluation. It's very long and extensive session with many financial figures and tables, and I will present your this co-generation project that will be based for our next discussions in coming sessions. So also we'll send you the financial spreadsheet in Excel with many pages containing assumptions, financial statement, etc., etc. So our task today is to discuss the process of financial modeling and project evaluation and proceed to the very financial model. Probably will continue this process on the next session too. So let's move on. So I will describe you the co-generation project. It is a hypothetical project. We then will refer to it as a co-generation project, and it can illustrate the basic elements of a project financing. Co-generation involves the production of steam, which is used subsequently to generate electricity and to provide heat. In this sense, the two forms of energy, electricity and heat, are co-generated. The owners of co-generation facility may use some of the electricity themselves. They can sell the rest to the local electric utility company. The leftover heat from the steam has a number of possible commercial uses, such as process steam for a chemical plant, for enhancing oil recovery, or for heating buildings. So what is the project here? Engineering firm has proposed to chemical company that is designed and build a cogeneration project at a chemical company's plant. So it's additional to existing plant of a chemical company. And it's proposed not by chemical company, not by any investor, but by engineering firm, you see. What are the project sponsors? Engineering firm has considerable experience in designing and managing the construction of energy facilities. The market for engineering services is very competitive. Engineering firm has found that its willingness to make an equity investment, to assist in arranging the balance of the financing, and to assume some of the responsibility for operating the project following completion of construction, and all this can enhance its chances of winning the mandate to design and oversee construction of cogeneration project. You see that to win this place in a market, the engineering firm have to go in a very complex project, because the market is very competitive, so you have to invent something to increase your share. But nevertheless, engineering firm basic business is engineering, and its capital resources are limited. Accordingly, it is anxious to keep the investment small and it's unwilling to accept any credit exposure. However, it is willing to commit to construction of the facility under fixed price turnkey contract, which will be backed up by a performance bond to ensure completion according to specifications. Then other parties in this project, the industrial user. Chemical company's plant began commercial operations in a previous century. Two aged gas-fired steam boilers produce the process steam used in a chemical manufacturing process at the plant. The local utility currently supplies the plant's electricity. Engineering firm has suggested building a cogeneration project to replace these two boilers. The new facility would consist of new gas-fired boilers and turbine generator equipment to produce electricity. The cogeneration project would use the steam produced by the gas-fired boilers to generate electricity. It would sell to local utility whatever electricity the plant did not need. It would sell all the waste steam to chemical company for use as a process steam and would charge a price significantly below chemicals company current cost of producing process steam at the plant. Chemical company is willing to enter into a stream purchase agreement, but it will not agree to a term exceeding 15 years, nor will it invest any of its own funds or take any responsibility for arranging financing for the facility. Chemical company is insisted that the stream purchase contract must obligate it to purchase only the steam that is actually supplied to its plant. So we have another component of this puzzle, the industrial user who will consume the output of the project. Then also local utility. Local utility is an investor-owned utility company. It provides both gas and electricity to its customers, including chemical company. Local utility has stated publicly that is willing to enter into a long-term electricity power purchase agreements and long-term gas supply agreements with qualified cogenerators. It has also formed an unregulated subsidiary for the express purpose of making equity investments. Its regulators have authorized it to make such investments, provided that local utility owns no more than 15% of any single project. Local utility has informed engineering firm that it is in support of this cogeneration project and is willing to enter into a 15-year electric power purchase agreement and 15-year gas supply agreement. Local utility has committed to accepting a provision in the gas supply agreement that would tie the price of gas to the price of electricity. The price of gas will escalate or de-escalate annually at the same rate as the price of local utility pays for electricity from the cogeneration project. Local utility is willing to invest up to 15% of the project's entity's equity and to serve as an operator of the facility. However, it is not willing to bear any direct responsibility for the repaying project debt. Local utility would also include the facility electricity output in its base load generating capability. A 15-year inflation indexed operating contract is acceptable to local utility. The contract would specify the operating charges for the first full year of operations. The operating charges would increase thereafter to match changes in a producer price index or PPI. These changes would represent only a relatively small percentage of the cogeneration project's total operating expenses. Because such facilities are simple to operate, the completed cogeneration project will require only a dozen full-time personnel to operate and maintain it. So we found a next piece of the puzzle. It's a local utility who can provide an operating management, provide an equity capital, and can grant consumption. So agree to purchase the results, the product of this company, of this project. But still we have the problems to solve. We should definitely find how to finance. So what we need outside financing sources. The balance of the equity and all of the long-term debt for the project will have to be arranged from passive sources. Principally institutional equity investors and institutional lenders. The equity funds will have to be invested before the long-term lenders will fund their loans. The passive equity investors will undoubtedly expect local utility to invest in equity before they invest their funds. The strength of the electric power purchase and gas supply agreements will determine how much debt will cogeneration project will be capable of supporting. The availability of the tax benefits of ownership as well as the anticipated profitability of the project will determine how much outside equity can be raised for the project. So that's the general landscape for the project. So that is the idea. We have the engineering firm who initiated all the things. We have industrial user who will consume primary consumer for the output of the project. We have a local utility who can invest equity and also manage and also consume the output of the project. And finally, we decided that the rest of finance needed we will found in external financial sources, primarily the institutional investors. So that's the general landscape. Go next. What we should do next? We should estimate the project total costs. Financial modeling plays an important role in project evaluation. Lenders are concerned about the timeliness of the project debt service payments, and equity investors are concerned about the adequacy of their returns. Cash flow modeling is used to address both sets of concerns. For project financing to be viable, the project's cash flow must be adequate both to service project debt in timely manner and to provide an acceptable rate of return to equity investors. The expected rate of return on investment must be commensurate with project risk. Equity investors require a high expected rate of return than lenders, and equity investors expect a higher return than a passive equity investor. So you have to balance those between the different sources of finance and the different required levels or either of return or debt service. Let us prepare the cash flow projections. And the economic viability of the project depends on the adequacy of the cash flows generated as compared to the cash flows that must be expended. The timing of the cash flow inflows and outflows is a contributing factor. Thus, discounted cash flow analysis is crucial in determining the economic viability of a proposed project and the adequacy of the rates of return that providers of capital to the project can expect to realize. Projecting the cash outflows and inflows is a critical part of this analysis. The cash outflows are typically easier to predict. They occur primarily in the earlier years of the project. The more distant operating cash inflows are inherently more difficult to predict. The discount rate chosen to calculate the net present value of cash flows or to evaluate the adequacy of the internal rate of return should take into account this riskiness. How to estimate the project total costs? First, the project total cost must be determined. The total cost includes, first, all direct costs such as engineering, labor, and material, and secondly, all indirect costs such as financing related charges, that is including interest, commitment fees, upfront fees, etc., 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 and the cost of financial guarantees or other credit support mechanisms. In the case of the cogeneration project, engineering firm and local utility, the two owners of cogeneration corporation, have agreed to pay various pre-construction costs, mainly the fees for securing the many permits that cogeneration project will need to have before lenders will advance any construction funds. And these pre-construction costs amount to $3 million. So we have a first input at hand. Then, engineering firm and local utility contributed these permits to the project in a return for equity in cogeneration company. The principal engineering firm usually supplies the construction drawdown schedule. The construction period allows time for preliminary engineering and licensing in addition to the actual construction. For the cogeneration project, funds needed during the construction period will be supplied by a commercial bank. Bank debt will be found 100% of the cost during the construction period. Engineering firm and local utility have arranged a 120 million construction loan facility. So we have next input, the sum of the loan. They have agreed to pay the bank a 1% loan facility fee on behalf of cogeneration company, and the bank received 1.2 million at closing. In addition, engineering firm and local utility committed to the bank that they will arrange permanent financing for cogeneration company. They estimate that cogeneration company will incur approximately 2 million of fees in connection with arranging and permanent financing. Construction period loans are generally made on a floating rate basis. So we have a framework for financing. We have identified the loan amount, the upfront fee, the other fees related to the setup of the financing, and the mechanism of setting the interest rate along the lifetime of the loan. Also, we have a contingency for cost overruns. We should have this contingency. The construction loan should have sufficient capacity to provide funds for contingencies and for fluctuations in the interest rates, because the construction loan entails loan fees that depends on the size of the loan commitment. It is important not to oversize the construction loan. So again, you have to balance between two things. First, you have to have some additional contingency amount of loan to allow for changes in the prices, etc., etc. And at the same time, you have to minimize the amount of loan as much as possible, because you have to pay for this loan, and it all comes at costs. Now we will go to the description of the capital costs, and I will switch here to the Excel model. I will also send this Excel model to you along with slides. Yeah. So you can see here the assumption page with all the assumptions bring together. So it's operational assumptions, construction and financial assumptions. You can see here all the amounts I already mentioned, but you can use it as a reference here. So the total project cost of the cogeneration project given at 2 years construction drawdown schedule, an interest rate of 10%, interest is paid on funds that are drawn down, and a commitment fee is charged on the unused balance of the commitment. It's very interesting history. Probably some of you already acquainted with, familiar with banking fees, but for a bank, it's not efficient that if it's committed, for example, for 100 million of loan to you, but you did not drawing all the loan and have the rest of loan, like half of a loan undrawn, it's not efficient for bank because the banks also paid for arranging a funding for you. So it's better for you to get the loan as much as you can, but again, if you need it. And for the bank to hold the loan undrawn is also not efficient because the bank is paying for the providers of the capital too for this loan. So the loan commitment is designed to accommodate high interest rates during the construction period and high construction costs. For example, if we change something in design. Construction is expected to cost 100 million. Commitment fee and interest will add 7.3 million, bring the total construction cost to 107 million. The unused balance of 12.7 million is available to cover cost overruns or high interest charges, including the 3 million of reconstruction costs and 3.2 million costs of arranging financing. Total expected project cost is 113 million, and the total project cost is sensitive to the interest rate applicable during the construction period. So if the interest rate is higher than expected, project cost increases accordingly. The higher project costs require a larger amount of permanent financing. The sponsors of a project can eliminate their interest rates exposure by arranging interest rate swaps. The bank would receive a fee of arranging the swap transaction, which will have to be added to the project cost. So you can use a mechanism of mitigating this financial or interest risks. And come back to the presentation. Here is a table where you can see the actual schedule for 2 years of construction drawdown, then calculation of commitment fee for each drawdown, interest expense, then goes to the total financing costs. Then we add from period to period and arrive to the total construction and financing, accumulative funds using, and unused balance of commitment. Okay. The next issue we have to consider is ownership arrangements. The cogeneration project's target capital structure is 25% equity and 75% debt. The proportions of equity and debt were determined by analyzing the profitability of the project. The greater the level of operating income that can be contractually assured, the greater the amount of debt the project can support. Cogeneration company debt will be non-recourse to the equity investors. Long-term lenders must look solely to the project's cash flow for their repayment. The equity investors will receive their returns in the form of tax benefit, dividends paid out of excess cash flow from the project. That is after payment of the debt service, and any residual value of the cogeneration plant. You see that we are here on a very modest and industry mean level of debt. That's 75% is pretty common for the industry of project finance, and if you recall the previous sessions, it can be as high as 100%. This picture shows the initial capitalization of cogeneration company following completion of construction. So it's the setup of the shares and their values after construction is complete. And total capitalization equals 113 million divided between long-term debt and equity. Engineering firm and local utility each own half of the general partner, Cogeneration Corporation. Here it is. You see, this local utility engineering firm, they both act as shareholders of general partner. Then we have other partners, there's limited partners, and here our special purpose vehicle, cogeneration company. So if you recall the schemes from the previous lectures, it's very similar to those that we have in the real life projects. Engineering firm and the local utility invest just enough fund in a cogeneration corporation to capitalize the general partner adequately for some tax purposes. Initially, the general partner will receive 10% of the partnership's income, losses, and cash distributions, and the limited partners will receive the remaining 90%. Once the limited partners have received cumulative cash distributions equal to their original investment of 25.5 million, the 10-9 split will change to 50-50. Probably some of you can recall from these lectures on alternative investment. What are the provisions for such a reversal? Can someone write or in a chart or say to me, do you recall how this provision allowing to reverse the stream or the distribution of the income stream? Any ideas? Who can remember from alternative investments how it's called? It's sort of catch-up provision. Means that, okay, until the limited partners are paid back for the initial investment, the general partner do not receiving the higher proportion of the profits. But if these initial investments are recovered, then we have to reverse the distribution of profits to favor the general partner for his efficiency. So we have many connections between this alternative investment course and this course for investment project management. It's all pretty interconnected. And the initial split that I mentioned is a proportion of the equity investors' respective investment in the cogeneration project. And following this reversion, the general partner shares equally with the limited partners with respect to the partnership income, losses, tax credits, and cash distributions. This shift in distribution arrangements is designed to reward the general partner if the partnership performs well. These arrangements reduces the limited partner's agency risk exposure because it gives the general partner a strong financial incentive to make a project successful. And let us discuss this next component to calculate and model the cash flows of the project. It's project economics. So what is the assumptions and for calculation of revenue and how it is calculated, what formulas are used? So we have a cogeneration project's principal source of revenue in form of sale of electricity under 15-year electric power purchase agreement with local utility, and from the sale of steam under, again, 15-year steam purchase agreement with a chemical company. Electricity revenues can be predicted with a high degree of certainty because the electric power purchase agreement defines contractually the price for each megawatt hour of electricity delivered to local utility each year for 15 years. And secondly, the capacity of the cogeneration facility to generate electricity is known, and the operating reliability of similar plants has been well documented. Then the steam purchase agreement established minimum purchase quantities specified by price per 1,000 pounds of steams, and provides that this price will increase during the 15-year term of the contract based on the annual change in the producer price index. The cogeneration project's operating costs are largely contractually determined. Local utility will supply gas under 15-year gas supply agreement. The contract specifies a gas price that will prevail during the initial year of the contract. Then the gas price will change in subsequent years in line with changes in the price cogeneration company receives for the electricity it sells to the local utility. So again, highly predictive. Local utility will operate cogeneration company. Its management fee will be specified fixed amount for the initial year, and they will escalate thereafter in line with changes in the PPI. So we have already settled in a contractual documents the prices for the output purchase agreements and for the management agreements. So all these are pretty straightforward, linked to the changes in the producer price index. So high level of predictability of the income streams and expenses. Local utility has agreed to maintain and repair the cogeneration facility in accordance with the agreed on fee schedule. An engineering firm has guaranteed that the cogeneration facility will operate at the design capacity for at least 15 years. So what we have now, we have also guaranteed the lifetime of efficient functionality of the project facilities. Let us check how it's all indicated in an Excel. So it's assumption page, then we go to financing. You can see the table that I present to you in presentation. It is all entered here as the inputs and the calculated for cells that will be further used in a modeling. So all the information you have, the construction drawdown, the schedule, the commitment fees, you can see and check, it's not any hard numbers. It's all calculated based on the assumptions and using the formula we entered here. We have interest expense that all are calculated. We have then the total financial costs, the total cost of construction and financing, the cumulative funds used, and then unused balance of commitment. It's also very important. We can see it here. Then we arrive to the total project costs, and we have a split according to the agreed upon proportion of the long-term debt and the equity capital provided. You can see the split again of all this financing between the general partner and limited partner. So you can easily check how it was calculated. So starting with the total project cost, then going to the assumption of the general partner share, that is 10% of 25%. So everything is pretty clear. I highly recommend you to dive in this model and try to understand the first modeling logic, business logic, how that is applicable for this model, and probably it will help you to develop your own models and evaluate projects. And also we have this financing schedule where I have the senior debt at the beginning of the period and the interest charged, the repayment of the principal, and the senior debt end of the period. And you can see that it's all will be repaid in a year 10. So it's also additional assurance for us and for lenders too, that all the debt will be well served and repaid in a 10 years. That is quite within the lifetime of the project, so no problems with obsoleting or malfunctioning of equipment, no problems with getting the purchase contract not working, because we have 15 years purchase contract for all the services provided by the projects and products generated by the project. And also we have the same 15 years agreement for maintaining, for supplying needed inventories, etc., etc., etc. So it should assure the lender that we are good on all aspects of the financing. And here we have the calculation of the revenue stream. So you have the electricity, that is again not hard numbers, it's computer numbers. You can see that we have the initial price per megawatt hour for the first year. We have the quantity of electricity provided in megawatts. We have the capacity utilization we start with, that the figures goes to this calculation of operation revenue. The same for the steam, all comes from the assumptions. Okay. For the easiness of usage, I repeat all the assumptions here and the same page, so it's easy for you to not going to the assumptions page, but just opening the this rows on the plus sign and see what are the assumptions that will affect this spreadsheet. And all it will be indexed according to PPI. You can see here again we have a figure from the previous year for the revenues for the sales of electricity, and its increase with either contractual escalator factors or PPI. Okay. What goes for the expenses? Here again, all calculated. What we can discuss for the rest of this session, let us switch to the table 2. It is summary of the assumptions and the models used for the cash flow projections. So I will repeat, we have a cash flow projections assumptions for the cogeneration project that is shown in this table. The contract volumes of electricity as specified in the electric power purchase agreement, and the steam as specified in the steam purchase agreement, establish the base output level for 15 years. The electric power purchase agreement specifies electricity prices. The steam purchase agreement provides a base steam sales price, which can be escalated using a forecast of future changes in PPI. The projected volumes and prices can be used to forecast annual revenue amounts, and the design of the cogeneration facility will determine the annual levels of gas usage. The gas supply agreement escalates the gas price to match future increases in electricity prices, which were used to prepare the revenue projections. Management fees and other operating expenses will also increase with the PPI, as provided for the 15-year operating contract entered into with local utility, and management fees are included in operating and other cash expenses in this table. And we have the second table, table 3. So the third table, table 3, it contains projected operating cash flows. They are based on the assumptions provided in the previous table, and when preparing a set of cash flow projections for a prospective project, it is important to give the critical details. So prospective lenders and equity investors are particularly interested in the assumptions because the projections are meaningful only to the extent the assumptions have a sound basis. And I should assure you from my own experience that it's pretty the same situation with each project. For example, we have a project of very small project for construction of service depot for the bus fleet in town of Tver, and it was supposed to be financed by either Sberbank or Web Corporation. And when we entered in a discussion about the assumptions that underline the financial model for this project with credit inspectors and credit analysts from these institutions, we even go to the details what exact the types of the fuel will be used, what is the exact types of the oil will be used in this service depot, what is the electricity grid provided power to this depot, even to the details what is the actual professional uniform will be used by the servicemen in this bus depot. So the credit analysts from this institution, it's very proficient professionals, really go into every detail and every aspect of the financial model, and it's better for you to provide all the details even at prompt notice or just already included in the model. So be prepared if you're bidding for huge money, huge loan, then you should go to the detail, not to have any assumptions like, oh, okay, we need a 100 million rubles or $1 million to construct this depot. Why do you need 100 million? Because we have this pretty same depot constructed in other city. No, it's not a good approach. You should go into detail and explain why it will cost 100 million. Maybe it's more or less. So both outcomes are unfavorable for a credit institution if we have extra expenses or lower expenses. It all goes to the inefficient financing. Let us have a break here. We'll have additional things to consider about this project, about the financial model developed, and about all the calculations made. What I suggest right now for you is to take a look at this Excel file I will send to you. And on the next session, we'll start from discussing the calculations already in a model. And I also would like to ask you how you are on the home task from the previous session. I was not asking you to prepare it by today, but it should be done and sent to me by next Saturday. So please, if you have any questions, problems, issues, etc. with this home task, write in the chat or say it to me or raise a hand. So I would like to see that none of you have problems of getting this home task done by next Saturday. If someone has, please tell me. Okay. Do you have any other issues to discuss right now regarding the course, regarding the material? So what is your opinion? What aspects or issues you want to discuss detail? Maybe you have questions for the previous sessions. So no problems, no issues to discuss right now. Am I correct? Hello? Yeah, good. Because sometimes I'm getting the feeling that nobody heard me, so probably some problem with my microphone or etc. So it's very important from time to time to receive a feedback from you. Okay, so by now let us finish the discussion of this code generation project. I will allow you to digest this very extensive financial information, to have a chance to dive into financial model. And of course, I also will send you the slides for today's lecture. And starting from the next lecture, we'll first finish this session regarding the financial model of the project, code generation project, and also we will try to review and I will try to provide my feedback on your homework. So I'm kindly ask you to done this homework as soon as it's possible. So allow me to have enough time before next session to evaluate your homeworks and give prepared feedback for you. Okay. Yeah, good. So thank you for your time. Have a good weekend. Try to rest. See you on next Saturday and on Wednesday for the alternative investments. Okay. Good. Bye-bye.